This is a screaming red alert buy signal. High risk growth portfolio, 233% total return in 2021, turned every $10,000 into $33,000. The high risk growth portfolio is up 1.99% in 2022. And this is our current trade alert for $10,000 if you're on a free trial. Right now, we're recommending you buy 88 shares of UVXY. That's the ultimate stock market crash insurance policy that can go up 10 times in a big crash. We're betting big on the Ethereum ETHE with 221 shares, representing about 60% of your portfolio. And now, instead of hedging with oil, which we just took a massive profit on today, we're switching to a new inflationary hedge that can give you more bang for your buck by buying BOIL, the Ultra Gas ETF. This is coming in at 99 shares. If we look at the asset allocation, we're essentially 12% long crash insurance, just trading at a very cheap price today. We have 60% in growth, expecting interest rates to fall back down over the next several months and take growth assets, technology assets, back to new highs. And just in case the levee breaks on the interest rates, you're hedged against inflation with BOIL. Now, BOIL could easily go up 300% to break into new highs if the right elements come into play. All in all, you have the ultimate portfolio for high risk entering 2022. And this portfolio costs about $10,000 to test drive today. So here's the most important headline right now. The bond market's at a critical crash level. If this is not supported by the Fed, all sorts of things are about to break, and your UVXY position will be there to save the day. The Nasdaq, Bitcoin, and Ethereum are also at critical levels, and this is 100% due to the bond crash, which we're saying is about to stop crashing for the time being. If the Fed does not protect the bond market, the entire global stock market will collapse. It's like a black hole that will suck up everything around it until it's been fed with assets. Simultaneously, China is firing up its money printing presses, and we're seeing that with Alibaba flying up over the last few days. The credit impulse in China is officially skyrocketing up. As the US slows down its fiscal impulse and monetary impulse, China is doing the exact opposite. And these major powers love to take turns printing money. I believe inflation is likely going to peak out by March, and this will slow the Fed's hawkishness. There's a lot of talk, but talk is cheap. They're still printing billions and billions of dollars every hour and will continue to do so through March. The ECB continues to print money by the billions per hour, and now China is getting ready to do the same. So again, a lot of talk to try to cool off inflation so that Mr. Biden can pass his Build Back Better bill. And so far, it's just not working. Here's Portfolio Builder's track record. The safe growth strategy returned 25% in 2021. And as of right now, up 0.62% in January 2022. Our high risk growth strategy returned 233% in 2021, up 2% in January in 2022. These are the key macro points to focus on in 2022. Don't forget, Congress increased the debt ceiling by $2.5 trillion. Now, this could have been blocked, but Mitch McConnell made sure the Democrats could spend all the money they like this year. So that may be the only thing that matters for stocks. If we look at this chart and look at the growth of debt of the United States, the more debt, the higher the stock market grows. That's really the trend. The only time we've had a 2-year stock crash in the last several decades was when we tried to have a debt surplus in 2001. That was the dot-com bubble. Congress learned its lesson, and has done a good job at growing the debt ceiling ever since. Stock returns have been beautiful ever since as well. So now they just need to agree on how to spend the money, with all parties being controlled by the Democrats, and perhaps even the Republicans are also in their pockets. I do believe they will find a way to spend that $2.5 trillion. Now, come midterms, that may start to change if we get a populist movement, but we'll worry about that come November. The other big bullish factor is that there's trillions in corporate stock buybacks planned right now. Now, today we got a low December labor growth data. It was anticipated to be 400 to 500,000 jobs, came in at 200,000. I believe with the new variant spreading like wildfire and the fear porn on the media, that this will keep job growth low until March. Also with zero policy in China, they've got their equivalent of San Francisco in a crazy lockdown right now. So chances for massive labor growth between now and March are very low, which is highly correlated to interest rates. So where do you invest your money? Governments globally are debasing their currencies at no less than 5% a year. There's no chance that trend is going to change anytime soon. This makes cash trash. Bonds are trading negative relative to inflation by likely the highest percentage we've ever seen in history. This makes bonds still garbage, even with this recent sell-off driving interest rates to critical levels. So there's still zero logical other options of where to invest your money. You need to be long stocks, crypto, and commodities until the bond market becomes too attractive, or until the Federal Reserve makes a massive policy mistake and crashes the economy. At this point, I still think they're mostly talk, and as the data starts to slow down on the inflationary front, they'll be able to delay and slow down this hawkish monetary policy, because otherwise they risk crashing the economy into midterms, which I think is really not going to be appeasing. So that's what's happening. Now, a strong labor market and rising interest rates are the key market threat. And we are seeing those interest rates rise, and we're seeing the pain in the tech sector. And again, I believe if the interest rates continue to rise, it will collapse everything around it. So that's what we're going to be focused on. So it's really important that over the next 3 months, CPI and CPI slow down. If they don't, we're likely going to have the Fed accelerate interest rate hikes and quantitative tightening and crash global markets. So it's very important that you watch our webinar every Monday, Wednesday, Friday to be ready for a trade alert. If anything goes haywire unexpectedly and overnight, our clients are not scared. We now own a 10% plus position in the VIX with the ticker UVXY. Last time we got a dramatic stock crash, this asset went up 1,000%. So a 10% position doubled your net worth. And if the other 90% went to zero, you walked away without a scratch. Here's that chart of UVXY, and you can see in less than 4 weeks, it didn't just return 1,000%, it nearly returned 1,100%. So now may be the very best time to follow our high risk growth and safe growth portfolios. Now that we took massive profits off of NRGU, a lot of these assets are trading at extreme discounts. And again, we love it when our clients buy low when everyone's scared and sell high when everyone's trying to buy the top. Okay, big picture, what are we expecting? A 5-year inflationary cycle with a slow but steady recovery and interest rates going up. That's really the main trend I see occurring. A slow motion rotation out of growth and into value. Now, again, as you know, we've just made a big bet on growth over value today, but essentially, this is just a small wave and a temporary trade before we're back into that oil play. This chart is XLE. And again, every time we go crash the economy and respond with aggressive debt issuance and suppression of bond interest rates, oil goes rocketing, and so do the oil and gas companies. We're only on the really the first year and a half of the inflationary cycle. So we've got another 3.5 years minimum, most likely to top out this current cycle. Now, this is just a reminder of how the markets tend to behave. In yellow, we have interest rates. If it's going up, interest rates are rising, and that's on the US debt markets. What we call growth or technology companies is the candlestick black QQQ. And again, I do place Bitcoin and Ethereum to be highly correlated to the Nasdaq as a technology. And then we have XLE, the energy sector. Now, it's possible for your growth and value to go up simultaneously. And if we look at early on in 2021, you had just that. You had interest rates rising, you had energy companies rising, and you had technology companies rising. But then the interest rates went skyrocketing up. The Nasdaq fell, Bitcoin fell, and energy kept rising with it. Now, the recovery was not intact. Lockdowns, all sorts of problems, China popping bubbles through their economy, you name it. Every problem that you didn't expect occurred in 2021. Interest rates came right back down. Okay, and what happened? You got your tech sector skyrocketing up and energy traded flat. So that's the big picture view. We're just believing there's a very pullback in interest rates with this current trade alert we're issuing today. So again, if you're on a trial and you'd like a walkthrough of the trading plan, if you'd like a trade alert that's different than $10,000, call Dean right now at 505-322-7515 to upgrade your membership. He'll take good care of you and get you on the right path. All right, very good. So let's hop into our favorite part, the data. Okay, so first of all, the FOMC minutes came out and the Fed's talking about 3 to 4 rate hikes in 2022, which was not new with the dot plots. We already saw that many of the participants were expecting that. What was new was talk of simultaneously hiking interest rates and doing quantitative tightening, which would actually mean selling bonds, and that would drive interest rates much higher until, again, it would crash the economy. So that's what they did exactly under Trump's watch. They began with rate hikes and then went into quantitative tightening, and then it took 2 years. So it took 2 years to go from hiking the rates and going into QT before it first crashed Bitcoin, then it crashed emerging markets, then it crashed European markets, and then when the 10-year interest rate hit 3% in October, you finally crashed the US stock market. So again, we haven't even started doing this. We're still printing money and growing the balance sheet. So I think overreacting to this hawkish talk before it's even begun is early. In this chart, we're looking at the reverse repo. This is going to be our best signal of when to get worried about interest rates really rising. And it's at $1.5 trillion. I'll be more scared when it drops below $1 trillion and starts heading towards 700 billion. This acts as a QE buffer. And so that's actually one of the reasons why they're talking about quantitative tightening, is to get this reverse repo back to zero. Right now, again, it's still at 1.5 trillion. What's the reverse repo? It's really the banks going to the Federal Reserve and wanting to borrow the assets they've purchased so that they can get high quality interest on safe bonds to pay deposits interest. And it's just that simple. So if this starts to fall, this means the banks have less demand for debt, and likely interest rates are on the verge of rising. In fact, you'll likely see interest rates rise as this falls. So still a huge cushion there, no reason to freak out based on that metric. As far as lockdowns, crashing oil, the new variant is not overloading the hospital system, but we are seeing those outrageous cases coming through as we speak. So I'm not predicting lockdowns in the US. Okay, so let's take a look at Boyle against NRGU. And we'll also compare it to lumber futures in a minute with the natural gas futures price. So you can see a very similar pattern between these two. Notably, back here in March, we can see oil go up. Boyle falls with oil. Oil goes back up, falls, but this time natural gas goes parabolic, has this massive 350% return. Both fall together, and now we have oil rising and Boyle's just starting to catch up. So I look at these two as highly correlated, except Boyle's trading at a significant discount from its recent top, while NRG was just broke to a new high. So if energy markets are about to crash, likely much less pain in Boyle compared to NRGU. And if energy is going to keep skyrocketing up, quite likely you could make 2 to 3 times the return on Boyle compared to NRGU. And for timing wise, we want to be out before the cold's over. So most likely into March, into February to exit Boyle. Now in this chart, we're once again looking at interest rates, energy companies in green, banks in red, and the tech sector in black. And this most recent move are rates going up. You've got your Nasdaq getting whacked. We've got banks and energy going up. So as you can tell, I'm expecting a reversal in the near future. And I do believe it will be some chicanery from governments trying to suppress energy prices, because it's really bad for also. We've got riots in Kazakhstan due to energy prices going up. It's going to be hard to pass the Build Back Better bill with energy costs at this level. So there's a lot of reasons why the government will want to suppress those energy costs. And it's just remarkable to see this correlation almost always play out. Rates go up, banks and energy go up, tech gets the hit. So Pelosi, if you recall, was all in the media for buying, I think like $5 million worth of call options from Google, Roadblocks, a few other tech companies. So she's underwater on that. So just funny commentary on that. I don't make much of Pelosi's trades. All right, in this next chart for our Safe Growth members, we have added to emerging markets through the leveraged ETF EDC. Again, we're seeing the dying Alibaba get a nice bounce. We had Charlie Munger of Berkshire Hathaway, Warren Buffett's partner, had a headline doubling down on Alibaba a few months ago. And this is where I think we're going to see the greatest growth over the next decade, essentially, that the US is going to be having to slow down its debt accumulation with a weak economy, and China is going to be able to accelerate it with a strong economy. And the trade deficits and the debt growth really also would confirm that. Plus, if we get a gridlock government in this midterms, that will also slow down the spending. Now in this chart, we can see emerging markets likes it when the interest rates are going up, and there's a lot of correlation to that. A third of emerging markets is China, and so we can see a lot of the pain in emerging markets has been primarily in China. So if we go back to June, the EEM is down 8% but the large cap FXI is down 19%, large cap Chinese companies, and another index in China, MCHI, down 21%. So if China is getting ready to stop trying to redistribute wealth and clean up bad debt in their economy and are ready to start expanding credit, get ready to have some really nice returns in emerging markets, especially if the dollar starts to fall, which is another expectation. Okay, Russell 2000, IWM, really full of a lot of junk, so it's hard to take it too serious. You got, AMC and GameStop, I think, are two of your biggest positions in there, and they're being, pumped against hedge funds, trying to short them, creating these short squeezes and such. But regardless, this index is often a good indicator for where the stock market's headed. And for the entire year, it's been trading flat. So it's not giving us a signal either direction currently. It typically goes up with interest rates rising, but I do want to note, even though interest rates crashed for the majority of the year, that IWM has stayed flat. So from that regard, I do look at that as relatively bullish. Okay, in this chart, we're looking at the European index we're playing for safe growth, also a hedge against interest rates. And again, even with interest rates falling, it's traded straight, which I look at as overall a bullish indicator. I'm expecting also great outperformance from the European index over this coming decade. Now, with that said, they do have some pretty wild mandates playing out throughout Europe. So we'll see how that plays on their economy as time marches on here. So I'd like to think the whole lockdown madness is coming to an end, but perhaps not. And we'll look at some of the news feeds on that front. Okay, so here is the dollar against the euro in a basket of emerging markets, but mainly it's the dollar versus the euro. And we've been expecting that the dollar would top out and start to fall. And that's really how we're positioned with it. And that is now starting to happen. So very good. So someone's asking what would make oil go up? Well, if the dollar falls, oil will almost certainly skyrocket up. If people need natural gas in general because it gets cold, bingo, that's what makes energy go up. So yeah, we could very well likely hit a huge win on oil if the dollar goes down. If the dollar goes down, I'd expect your emerging markets to perform very well. Really, our whole portfolio is designed for the dollar to not go up. So the returns we've made with the dollar rising for much of the year are quite remarkable. As the dollar falls, we should see much greater performance moving forward. Okay, the Chinese currency continues to strengthen. All the fear of China, and they have record imports, record exports, and their currencies outperform the dollar. The only currency that's really outperformed the dollar in the last year is the Chinese yuan. So not worried about contagion from China. The Turkish Lira has stopped crashing, so we're still keeping a close eye on that. Let me pull that one up. And this, this is one of the primary problems in the market, was the Turkish Lira. And so we can see it hit 16.5, pulled back to 11, and it's slowly drifting higher. So we'll see if the clever guarantee against Forex losses is going to work or not. it worked temporarily and now it's starting to fade again. So still keeping a very close eye on that. I'll have to make a separate slide for the dollar and the Turkish because this always happens to us every time we try to do that chart. I'll have that fixed for next webinar. Okay, this was an indicator I ignored this summer, and we could have pulled the same profit on NRGU twice had I not ignored it. I was certain energy was going higher, but I wasn't expecting it to take a temporary dump through summer. And lumber futures predicted that, as you can see right here. So we had lumber futures go skyrocketing to 1600, as we all recall. And then it fell off a cliff. And then now what is it doing? It's skyrocketing back up. So based on oil and based on lumber futures, I'm believing this is predicting natural gas prices are going to make a new rally. Now, why did it tank? We actually sent a lot of natural gas from the US to Europe, and that helped bring prices down as they're having a really bad energy crisis. Unfortunately, I think the energy crisis is going to be with us for the next 5 years due to massive underinvestment and bad policy from governments trying to essentially go to green energy is causing all these, well, causing a lot of the underinvestment. So yeah, get excited. We could see a very nice return on oil in the next 2 months. Okay, in this chart, we're looking at the stocks that have held up the whole Nasdaq, which at this point are primarily Microsoft, Google, Apple, Tesla, NVIDIA. Let me put Google back on there. And of course, Amazon. But we can see really the ones really still holding these outrageous returns are primarily Tesla, NVIDIA, Apple. So why do we bring this up? If we're going to have a growth to value rotation, can the value companies absorb the market share of these massive tech companies? And that's certainly an important question. Now keep in mind, the bond market will help absorb some of that as well as interest rates rise. But so far, the leaders are not falling off a cliff and still at very elevated levels. If we zoom out a bit, we can see some of these massive returns. And the main one that really stands out, obviously, is Tesla, up here at 2,000%. Perhaps the best canary in the coal mine for tech. Now we're looking at where some of the rotations happening in the S&P 500. And we've actually had Berkshire Hathaway outperforming tech. Everybody's really ragged on poor old Warren, saying he's lost his game. He's like Michael Jordan playing golf or baseball, this and that. But he's having a good return. Today we have Bank of America skyrocketing up. So Home Depot, United Health, Johnson & Johnson, Procter & Gamble. Let's throw back Visa. Visa only trading flat, and Pfizer down a little bit. Let's zoom out a little bit though. So this is where we're starting to see some of the money rotate out of the huge, giant, trillion-plus market cap tech companies into some of these less valued, but still up in the top 20 S&P 500 companies. So that rotation is slowly but surely happening. Okay, in this chart, we're looking at 3 of the key stocks out of Asia, and I've really boiled it down to Taiwan Semiconductors with TSM, Tencent, the mega software company out of China, and then Alibaba, the Amazon. I've been really waiting for Alibaba to give us a signal that investor sentiment's starting to become more positive for Asia and specifically China. And so we're finally getting that bounce. We've had some head fakes, but perhaps that bottom is in and we're about to have greater outperformance in emerging markets, which we're playing with the ticker EDC. Now, out of the European index, we're focusing on AstraZeneca and Toyota. That index does not have 5% positions like the Nasdaq or the S&P 500 has, so it's very diversified. These are two of the larger positions, and again, they've been holding just fine and dandy despite interest rates falling. And again, these tend to go up with interest rates rising. So no reason to be concerned out of that. Okay, NRGU is playing essentially Exxon times 3 is really the play. Now it's the top 10 US oil companies. If we're looking at resistance level, we're right at it. So I believe we're likely going to see oil pull back soon with NRGU, if not trade flat. And we'll be looking for any amount of volatility to rebuild into that position. As far as calling a top for NRGU or Exxon, I'd expect, unless the Fed goes into heavy duty rate hikes, which is a game changer, that we would see Exxon go to new highs, that we'll see the dollar index at 90, oil go above 100. So the only thing that would really stop that would be dramatic lockdowns, killing energy demand, or central banks aggressively hiking interest rates, and that would do the trick as well. So we got to be very careful expecting Exxon to go back to above 100. Would send NRGU potentially to 450 to 600 if the Fed indeed is going to go aggressively into rate hikes, which I think we'll have a better idea of by April by following the labor growth, the PPI, and the CPI, which we'll be looking at in a moment. Okay, so here we were talking about the bond market and the oil market disagreeing. Typically, these two are tied to the hip. And since May of last year, they've been going in opposite direction. I was caught off guard thinking oil would not pull back in the summer, but did not sell. Rather, we just stayed put and added to it. And eventually that did pay off. Now, if we zoom in a bit, we can see they have become far more correlated. And again, I believe the government's going to have to come in and try to slow down the energy costs so they can pass the Build Back Better bill. So surprised with the super hawkish rhetoric that it didn't do the trick yet, to be honest. That's quite remarkable. Here is the copper futures market, with China getting ready to put the pedal back to the metal for growth. I'd expect copper to jump higher. Very similar chart of the Russell 2000 trading flat for a year. So again, this is not giving us a bullish or bearish signal. If we look at the futures, if we look at oil, that's telling us this is likely going higher. Now, the Baltic Dry Index is not giving us that bullish signal. It's been selling off, so keeping a close eye on that. It's still at very elevated levels. If this is going to follow the path of lumber futures, it should bottom out here around 2000 and start heading back higher. So we'll keep a close eye on that. And we've got China doing all sorts of crazy lockdowns over small amounts of cases. So it'll be interesting to keep an eye on that. In this chart, we're looking at the 2-year, 10-year, and 30-year interest rate on US debt products. The 2-year is where the Fed typically follows for rate hikes. And so in the turquoise or cyan blue color, it's screaming out loud, the Fed must hike rates. And they do typically do what the 2-year tells it to do. So they're now expecting the first rate hike to begin in March. Now, if we zoom in a bit, we're really more positioned for the 2-year to slow down and the long end to go up. And we're starting to see that. Previously, we literally had the 2-year going up and the 30-year going down. So we're starting to get the yield curve to create the shape that we're positioned for, which would be essentially interest rates rising over time. Now in this chart, we're looking at the three bond markets, the TLT, the JNK, and the LQD. TLT funds your government, JNK funds your, it's called the junk bond market or the Russell 2000 primarily. And then LQD is funding your tech giants or the top companies in the S&P 500 with investment grade bonds. All three are falling, and this is what we've warned you is not good for markets. I believe these are going to stop falling very soon. If they don't, prepared to get more hedged on UVXY would be the play. Now, the most important of all is by far the TLT. It is many magnitudes larger. If you think of the US as the single largest corporation in the world that drives the inflationary and deflationary impulse, then you can start to understand how important this is. So the last time we had extreme volatility was down here. Let's go to a price. So this is when you saw, so if we recall in December, Trump passed a $1 trillion stimulus. And then when Biden became president, he passed a $2 trillion stimulus. And bond market had a fit, and it fell on the TLT to 134, which was 2.4% on the 30-year. Okay. Then oil fell, and we believed that that trend was going to stop. And we had interest rates fall, which means TLT goes up, and that happened for the entire year. Well, now we're back at that 2, and I believe if we break that, you're going to see a lot of pain in markets. So this is going to be very, very important. TLT going below 142 and staying below it is quite likely to create massive disruption in the Nasdaq specifically. And potentially cause a crash in the cost of oil as well. So that's what I'm going to be primarily focused on. And again, this is very oversold, and I believe is due for a rally. So keeping a very close eye on that as we go into next week. This chart, I have Tesla and Ethereum overlaid. And you can see just how correlated they are. They don't go up and down at the exact same time, but very similar patterns and returns. Depending on how far you go out, Tesla's outperformed. But again, we can see just how much these two are correlated. Now, previously, Tesla was telling us to buy the dip on Ethereum, but now we've had that pullback on Tesla. So at this point, I do believe the interest rates must stop rising, or there's dramatic pain headed to the tech sector. So we'll be following that very, very carefully. Here's your boring old gold and silver, doing a whole lot of nothing over the last year. We are now out of silver. We can look at getting back into it in the future. At this point, it's not a top interest trade for me. Because if rates come back down, I think you'll get a far better return with the Nasdaq or with Ethereum. And that's likely what silver wants as well. Now, if we're going to go into a deflationary cycle and start balancing budgets and fight inflation for years and years to come, like the 70s, the products that I like in the short term are UVXY. After the damage has been done to the bond market and interest rates hit levels we think are peak prices, I would like TMF, that's TLT leveraged. And then I would also be building into a cash position with EUO. At this point, the only position that makes a lot of sense is UVXY. Now here's a whole bunch of different special plays that we're watching. So tan would be solar. If we're going to have a big sweep of Republicans in the midterms, not a huge fan of solar anything, which is all coming out of China. So that's out of the portfolio. The MJ position's been a big dud. Would have thought that would have had better returns for us. We're out of that currently. Remx I like regardless of who's in power. The big tech giants need the lithium and the cobalt, and your way to get that is through Remx. Uranium, I do believe, will be a very good long-term play, as that's the only way we get to net zero carbon emissions. The carbon credit, KRBN, has been a great performer in red. If I zoom out, you can see it's really been dominating with low volatility. We have not been playing that, but I've been watching it. KRBN is the carbon credit. Some plays that I've been considering for after getting out of boil are DBA and corn, a food play. So at this point, we haven't made any decisions on that. If I zoom out a bit, let's see how much, they're only up about 9% since last August. And so what we're looking at is the inputs for fertilizer have gone skyrocketing last year, and that's likely going to come into the cost basis for food this year, which is likely going to cause a lot of problems in poorer countries this year as well. All right, the bloodbath in crypto we have on the screen. So we're finally seeing Ethereum act as it should. It should have more volatility on the downside and more upside on the upside. There was a small period where it had less volatility and more upside than Bitcoin, but that's been changed in this correction. We still have Binance as the fourth largest coin outside of Tether. We do have two stable coins in the top 10, USDT and USDC. Solana has overtaken Cardano. Ripple still fighting the SEC. Terra Luna on the 9th spot, Polkadot in 10, Avalanche in 11. I'm concerned what advantage Solana, Cardano, and Avalanche will have in the marketplace as Ethereum switches to proof of stake, partnered with Polygon. So at this point, keeping a close eye on its competitors, and I believe Ethereum is going to really potentially have some great returns as it does switch over to proof of stake. Should be starting to have some progress in, oh, there we go, in March. I believe we're going to start potentially seeing some moves for Ethereum. But what's notable, for example, I was able to, less than an hour, stake $1 million worth of Ethereum at Aave, which is built on the Ethereum platform, take out a collateralized loan of $600,000 at an interest rate of 0.29, and it took me less than 10 minutes. No bankers involved. Beautiful technology. It's just an absolutely beautiful technology with a lot of growth ahead. It is truly amazing technology. We're very excited about holding Ethereum for the long term and hedging those risks as we watch it really really grow and turn into a beautiful product. And it's no wonder the banks are so frightened of what this is doing to their industry. Okay, copper to gold ratio, just to give you a feel for how long these cycles can go, 2002 to 2007, 5 years where copper went up faster than gold, predicting interest rates would rise. That's exactly what I'm believing is going to occur in this cycle. And the greatest performer over that cycle was emerging markets. So we have a heavy duty position in that with our safe growth strategy. This is predicting when interest rates will rise, and it's in March. They're now predicting the quantitative easing will end in March, and they will announce the first rate hike or actually execute the first rate hike. So if the growth slows down, if the inflation slows down, if the economy turns over and they have a hard time passing the Build Back Better bill, China is continuing to lock down ports and screw with supply chain. A lot of things could happen to slow down all this hawkish rhetoric. On the other hand, they did print $12 trillion globally, and now it's flying through the economy with supply chains disrupted, and people can't find work, wages are rising. Perhaps this inflation is going to be much worse than investors expect. And the Fed will be cornered into a position where they have to crash markets to stop the inflation. So that's going to be our primary focus in the next few months. This chart, we're looking at the yield curve in the orange. We go back to August. In blue, January. On the x-axis down here, we're looking at the duration of debt. On the y-axis, we're looking at the interest rate. And so what should we note? We're seeing the short end go up, signaling short-term inflation is problematic. The Fed needs to hike rates. And recently, we're seeing the long end start to steepen, which would signal that this is going to be fine and dandy, and everything's just going to work out perfectly. What we had been seeing was the opposite. We were seeing, as you can see in the green to orange, this was going up while the long end was staying flat. And that was predicting the Fed would hike rates and crash the economy. Now, if we go back much further, we can see what the banks want the yield curve to look like. And what's really funny is we have to go back to right before Trump and Biden passed a bunch of stimulus. And there you go. That's the shape that they ultimately want it to look like a skateboard ramp. And as you can see, it's hunched the wrong direction, and it's actually inverted today on the 20 and 30-year, with the front end rising way too fast. In this chart, we're looking at the VIX term, and it's very flat. There's not a lot of hedging going on. There's massive trillions of dollars that takes insurance money betting on a crash, and then they suppress the hell out of it. So when that snaps, that's when you're going to really get the big crash, and one day that'll play off. I'm sure if that TLT is going to rise, yields are going to fall, and we're not at that moment in time yet. But just in case, you are now hedged because the bond market's at a critical level. So we have you completely protected against a significant crash. Here's a look at some of the pain in the crypto market. Polkadot down 51%, Solana 44, Cardano 39, Bitcoin 34, Ethereum 30, Binance 30. Polygon actually up, the layer 2 solution for Ethereum, and Avalanche flat. And that's just since November 8th, looking at that volatility. Okay, what's going on with this new variant? It is spreading fast, but it's not creating serious ICU ramp up of hospital. It's not overloading the hospitals with sick people. It is overloading the hospitals with people who want to get tested, though. Like we're hitting a peak in the UK. In South Africa, it's clearly peaked and troughing now. And in the US, it looks like we've peaked out and it's going to start falling now. So that's what we're watching for. Now, I do have with specific European countries that had a double wave with this new variant, which I'm currently watching. Rose says, will the Nasdaq go up? Yeah, if interest rates fall back down, I believe the Nasdaq will go back up. And I think it's critical it does right now. George says the new variant was released by a white hat who wants to get the world back on track. Yeah, it does look like it was lab created. Fascinating. Yeah, it does look like it was completely man-made. Okay, there's that chart that I was predicting would occur. And so there we go. It has hit a record high of cases. What I didn't anticipate was how harmless this, the new variant would be. So good for that. And again, that's why we didn't sell our NRGUs, because we quickly realized this was a harmless variant that was not going to spark lockdowns, and that paid off. This chart, we track the debt issuance from Mrs. Janet Yellen. And as long as reverse repo is at $1.5 trillion, we're not going to be worried about issuing a lot of debt, making interest rates rise. So we can see she is starting to sell a tiny bit of debt, not a lot. Okay, producer price index jumped. It had traded flat for 4 months and then jumped up significantly from 8.6 to 9.6. So this has to stop rising. I mean, this is obviously the input cost on one end of the CPI. The other would be obviously the labor costs. So the rate of spending money in the US and globally has slowed down dramatically by trillions of dollars. So it makes sense that the rate of change of inflation should also start to slow down. I'm not saying the cost of goods are going to fall. I'm just saying the cost of goods should stop accelerating up so quickly as the rate of spending slows down. Now, this amount of spending that we punched into the economy has never been done in the history of mankind at this speed. So we're all watching it play out, and we're gonna have to watch the data every week to try to get a feel for when the inflation is gonna top out and simmer back down. And then we can worry about what impact the Build Back Better bill has if and when it passes. But the big inflation was from Trump immediately, right when this all broke out. And we increased the debt by $3 trillion in one package. And that's the inflation we're playing today. So it's really funny that Biden's probably going to be the worst, one of the worst presidents in history because of inflation. And it's all going to be because of Trump spending and the central bank printing. So just comical from that front. Okay, jobs, the potential for labor to come back online is massive. There's still massive amounts of jobs. Now, some people like Daniel D. Martina Booth claim that perhaps employers are listing jobs all over the place, and maybe there's duplicates. Regardless, there's a very elevated level of companies trying to hire people. We're having record amounts of people quitting their job. I believe it was 3.5 million quit their job last month, and they're looking for a better paying job. So the risk of the inflationary pressure from the labor market is certainly there. I believe this is going to pick up pace in March after all the variant drama comes to an end. And it could actually start to pick up in February, but based on the South Africa data hitting a peak and trough so quickly. This was very low, but there's been a trend. The government, it's really funny, but the government and allies really don't want jobs to come back online and drive interest rates up because it crashes tech stocks. And so the trend has been to underreport the non-farm payroll and then to revise it higher months later. So this print came in very low. So do we have a tight labor market and there's just no more people that want to work? And should the Fed hike rates because the labor's recovered? And if so, we need guys, we're over 4 million jobs below the lockdown. And what impact will that have on the economy? But that's a very, very weak non-farm payroll print. Now, granted, they have been revising these months later and possibly to try to stop interest rates from rising. Okay, wage pressure we can see is steady. It's very negative relative to inflation. Is this going to start impacting retail sales? So far, not yet. And there's trillions in savings, pent up demand. So at this point, I'm not worried about corporate earnings falling off a cliff in this next quarter. In fact, it keeps hitting new highs. Salary growth is slowing down, but still rising at a higher level than we've seen in history, to be clear. So we can go back 10 years and it's averaged 5%. After we lock down the world and print trillions, it's been growing at a 15 to 10% rate, 2 to 3 times higher than historical averages. Again, that's going to potentially put pressure on inflation. Okay, so this is the core inflation I track. There's another that traded at 6.8 last week, and people are predicting it's going to hit 7 and next week. So we'll see. I wouldn't be surprised if inflation rises for the next months. Hopefully, we're going to see the rate of change slowing down. So just smaller increases. So we went from 4 to 4.6 to 4.9. It's rising, but at a slower rate. The difference was 0.6, 0.3. So we really don't want to see it jump rapidly from here. Otherwise, anticipation of aggressive hawkish Fed moves would become predominant. And that would be very bad for technology stocks and cryptocurrencies. Okay, jobless claims trading flat. Labor force traded flat. Unemployment went down today. But the problem is we have not recovered approximately 3 million jobs right here. Excuse me, 4 million jobs have left the market and do not seem to be coming back. All right, in this chart, we're looking at the loans and leases and credit. And again, this is very important. We want to see the banks are expanding credit as the government's slowing down its expansion of credit. So this is very healthy for the economy and exactly how we're positioned. Consumers continue to grow their credit. And again, that's extremely important for corporations. Retail sales continue to grow. All the bond bulls who are getting wrecked today have essentially been predicting that this was going to go negative due to government subsidies slowing down. But so far, it's not happening yet. Yours truly, I believe, just got over the corona. No medicine, no nothing, just slept. So consumer spending, as you can see, new record high. The rate of change is slowing down, but this is at extreme levels, as you can see in this chart. Kathy says, what's driving down Bitcoin and Ethereum? Well, I've been talking about that the whole presentation, Kathy. The bond market's dragging down Bitcoin, Ethereum, and tech stocks. Interest rates, correct. Yeah, the bond market's a black hole for tech stocks. All right, here's the balance of trade. This is how we're positioned. Basically for the dollar to go down because we import more than we export and we grow our deficits, called the twin deficits. What would change this would be decoupling from China and bringing manufacturing back to North America. So that would dramatically change our positioning if we were to see something like that. Which we could worry about probably in 2024 if we get a populist back into office and have more populist House and Senate, which could potentially occur. We'll see as we get to November and respond as the data comes in on that. Personal income, again, not crashing. A lot of the bond bulls thought the whole thing was all the wheels are gonna fall off as the unemployment benefits came to an end, but not yet. There's more money circulating and it's flowing through the economy just fine. China's PMI is bouncing back up as their credit's expanding. Looks like they're done with trying to redistribute the wealth of China and pop bubbles, and now they're getting back into growth mode as the US slows down. Chinese imports hit a record. All bullish. Chinese exports hit a record high. Europe having a slowdown in its PMI, but still well above 50. The balance sheet in the US, with all this hawkish talk, headed to $9 trillion. So talk is cheap. We'll see if they backwalk this or not. But yeah, what do you want heading into midterms? A healthy economy with high inflation, or unemployment, crashing stock market, and you've killed the inflation. And so that's really the decision that policymakers are fighting with. ECB did trade flat week over week, but you can see their balance sheet's been growing. This is the most correlated indicator for stock valuations, and it's not going to peak out until March with current plans. And Japan grew their balance sheet. Rob says, are we at the bottom for Bitcoin and Ethereum? I think we are if the bond market stops crashing. And that's what I believe is causing all the pain. Okay, very good. So let's go ahead and hop into our news feed. This guy is really fun to follow on both YouTube and Twitter, Spot Gamma. And so all he's pointing out is the Nasdaq hit a wall at 380. Oh, sorry, it just updated. So China continuing a no corona policy, and their equivalent of San Francisco is Shenzhen. And so just, again, should keep interest rates lower if nothing else. But on the other hand, it's going to increase costs if ports in China are locking down. So I'm just, still don't have a good read on what policy is going to be. If we look at Australia or China or Austria or France or Italy, it's still quite draconian. In the US, it's starting to really ease up. We're seeing the blue states having to follow the red states because of politics. So mixed bag there. I don't have a good answer from a health standpoint. I think everything should be easing, but from watching some of these smaller countries and their policies, they're not at all. So we'll have to keep a close eye on that. Bab says, you think the housing market's on the way down? Well, you know, keep in mind in the massive housing run up from 2002 to 2006, interest rates were rising until they finally crushed the demand for loans. So houses sold off in 2006 through 2009. So I'm not saying the housing market's crash right now, but I do believe if interest rates go towards 3% on the 30-year, that you will crash a lot of things. Lisa Abrowitz says the biggest pain may be for traders to believe in a much more hawkish Fed and higher long-term inflation, only to be met with moderating inflation, a backpedaling Fed, and slowing growth by year end. Not a prediction, just an observation about market positioning right now. So I like that because that's actually what I think is about to happen, at least in the very short term. And we'll be ready to change mindset if that PPI, CPI, and energy costs don't cool off soon, because then the Fed probably will have to respond to this, and that would be very negative. Okay, here's Jim Bianco saying, wait, can we get a second wave? So Belgium apparently having a double wave on this new variant. Netherlands, clear double wave. Yeah, were they just not test over the break? Maybe. That's potentially in Germany, kind of. And then Austria. So yeah, this thing just doesn't want to go away, does it? Just keeping a close eye on it. Rick Ryder of BlackRock, the job report gains for December came in at 199,000 today, with October and November revised higher by a total of 141,000 jobs. Now note, they've been doing this every damn month for the whole year, especially through summer, which I believe is to try to slow down rates from rising, which appeared to disappoint consensus estimates. Let me zoom in a little bit so this is easy to read too. But we think there's a good deal to be impressed with given the constraints to the labor supply. It's very clear to us that labor shortages in certain sectors, as well as concerns over the XYZ variant of Corona, are holding back what could be even stronger headline figures. Also, when looking at the average monthly job growth in 2021 of 537,000 jobs on a headline basis, it's clear that employment is running quite strongly, and we think supply constraints are a limiting factor. More, after a very sizable decline in November, the unemployment rate declined again impressively in December from 4.2 to 3.8, while the labor force held steady. Bab says, why are the MJ stocks doing poorly? I don't know. All the fundamentals are good for them, just not the pump, the stock promotion it needs. Jeff says, move to Florida, safest place. Well, Dean would agree with you. Okay, Rick, we believe that as supply constraints ease and after the variant peaks, there should be more upward pressure on labor force and participation rate. I agree. Now, I was thinking that'd be in March, but maybe a little bit sooner. So we'll have to keep a close eye on that data. There's a extremely strong trend between the number of cases being negative relative to labor growth, to be clear. For now, however, surveys show that many former workers are still being kept from job searches by child care responsibilities, which the Build Back Better bill would address, employed spouses, and the significant financial cushions that many households have built over the past 2 years. Additionally, average hourly earnings increased by 0.61% month over month, nowhere near the CPI, but again, that's a lagging. Obviously, the prices go up and then employers have to respond to that delayed. On the monetary policy front, strong economic growth, labor market recovery, and elevated inflation clearly have moved the Federal Reserve toward an accelerated focus on shifting policy, and particularly in getting QE over with, which we think is long overdue. He's been saying it's long overdue for many, many months. Indeed, the Fed continues to run behind the curve. They're talking about the federal funds rate being below the 2-year. Jeffrey Gundlach had a funny tweet saying that get rid of the Fed. All they do is do whatever the 2-year tells them to do, delayed. And one of the more significant questions for markets over the next couple of months will be how quickly and precisely how policymakers decide to catch up onto conditions. Unfortunately, waiting to act has placed the Fed in an awkward position where policy normalization now may appear a bit clumsy and difficult for markets to interpret. So watch for greater volatility as this process unfolds. Here's Zero Hedge saying the Fed has almost no doves left. Now, typically, Powell will send some of the less important folks to go test out ideas on the markets and see how it responds. And we've been seeing a lot of hawkish talk. This Mr. Whale's a character. He's been calling for a crash in crypto for about as long as I've been following it. And he was saying, watch, if Bitcoin gets near 40,000, he predicts that Coinbase will have a scheduled maintenance, and and they've been doing it. These exchanges have been collaborating to shut down trading activity when volatility gets high, to calm the nerves and reboot. And then I don't know if this really happened, but I have seen it happen. The founder of Ethereum says, my argument for why the future will be multi-chain but not cross-chain. There are fundamental limits to the security of bridges that hop across multiple zones of sovereignty. So he's basically saying it makes a lot of sense to design Polygon on top of Ethereum, but not to try to bridge the gap, to bridge between Ethereum, Cardano, and Solana. That this would essentially create too many security loopholes. Now, what we've really seen in this decade is the big players crushing all of its competition over time. So if you bet on Solana, Cardano, Polkadot, and Avalanche overtaking Ethereum, you're looking for 1,000% gain just to catch up to the market cap of Ethereum. So you get your risk reward if you do make that bet. But history has shown us in general that the leader has tended to be able to monopolize and dominate. So we're betting big on that Ethereum. It's a very cool platform indeed, with a lot of success behind it already. This is a cool little, what do they call it? Barbell of returns. And we can see the most common return, and this is primary after the interest rates went skyrocketing up through the 70s. You can see that massive pile of 20% annualized returns. A lot of people have been printing the typical return after a 20% return, and in about 90% of the time, it's a positive return the next year. So, of course, we don't want to just look at random statistics to predict the future, but you can see this various set of returns. Now, if you buy GBTC or ETHE, it's trading at a discount relative to the assets it holds. What we've seen is in downturns, Ethereum or ETHE and GBTC are selling off more than the underlying asset, which is not fun. The good news, though, is on the upside. We've seen it just in recent times get that discount to 5%. So you could potentially, on the next upturn in Ethereum, outperform real Ethereum by about 10% if it was to close that discount window. Bab says, isn't Polkadot able to go between exchange to different? Polkadot is proof of authority. I'm not an expert on that algorithm, but he did help build Ethereum as a key programmer. Okay, so there's a massive amount of put options sold at the 280, excuse me, 380, and that's exactly where we bounced off of. So this guy's an expert at looking at options, specifically where options are sold and what impact that will have on price. Um, Now, yesterday, one of the Fed folks, Bullard, says if inflation moderates, we could slow down the rate hikes for 2022. So again, that's what we're essentially expecting at this point in time with the way we're positioned. Varad Market says, how can the Fed be even more hawkish in the near term than what is priced in now? So the pricing of the market is that the tape will end in March and a 25 basis point hike beginning in March. And to start the balance sheet runoff in either quarter 2 or quarter 3. Wild options. Abrupt taper end at January, 50 basis point hike in March, and balance sheet starts in April. Now, what would cause them to do that? You'd have to have every price that's sensitive to the CPI going straight up from here till January and March, which again, I think is unlikely. Jen Nordvig says the most relevant part of today's job report is that wage growth is running around 5% year over year, compared to 3% in the 2017 to 2019 cycle. This cycle is different, and the Fed is increasingly acknowledging that. China credit impulse tends to lead Chinese stock prices relative to emerging markets by 1 month. And there's that credit impulse. So we can see it's starting to go back to positive. It's nowhere near really punching that money. And again, what do they need to do? They need to stabilize real estate prices, because much of the Chinese wealth is in real estate. So I believe the tightening cycle in China is over, as they see the US must slow down. We got Trudeau going, Canada's still going crazy on this. Where's the pain from crypto? Besides from the bond market, I do think Kazakhstan, which is the second largest miner, we have noticed when mining goes down, it does put negative pressure in selling in crypto. So their internet was just shut off. There's a civil war underway. So that could be a part of the problem. We've also seen Turkey going insolvent, causing potentially selling and pressure on the dollar. And then we're seeing a lot of people get wiped out in China, also potentially causing pain. So we've tended to see selling at night if you're US based and buying in the day. And in general, we're seeing the bigger wallets accumulating over this period. So it looks like very rich US investors have been slowly but surely buying all this selling pressure in the crypto space. Mr. Whale says dozens are dead and thousands are injured from the civil unrest in Kazakhstan amid their energy crisis. The cause, Bitcoin mining sucked the grid dry and left the country starving for electricity. I don't know if that's true. I do know it's the second largest mining and potentially part of the selling pressure. And again, what's crazy about this index with this market is that it's very easy to go take your position and borrow against it to get leverage. And so small amount of volatility turns into forced liquidations and lots of volatility. As long as you're not fearful of volatility, it can lend to buying opportunities. Of course, anyone who's lived through the 2018 crash in crypto always thinks twice about, is this really the bottom, or are we going to see a complete collapse? But keep in mind, we had 2 years of interest rate hikes and quantitative tightening to get to the point where we collapsed the cryptocurrency space. And are we there yet? No, we're just talking about doing it. We haven't even started. Tracy Chai Girl, a energy expert. This is a very scary chart. The energy crisis is just starting. We need investment somewhere. World energy investment has declined due to falling investments in fossil fuels. So demand is going up and investment has been falling for an entire decade. It's going to get more and more problematic. You try to get carbon emissions to zero, and you're going to need even more energy to get there, which is the ironic part of it. To get all the lithium and uranium and all this that we need for clean energy, you have to go a bunch of dirty energy to get it all in your hands. And plus just general demand for energy is growing consistently. Lance Roberts says, if higher rates and inflation drag tech stocks, but are better for value, the problem is that the value sector don't have enough weight to offset the drag of the sectors hit by selling. So he's looking at this chart. So energy right now is 3% of portfolios, while tech is 29. So if tech were to reduce by even from 29 to 20, could energy triple? Is essentially what he's describing. So you can see typically what happens is you get tech rotating into value as interest rates go up, and then it all crashes together. So that's exactly what we're anticipating in this cycle. Almost a fifth of the Bitcoin's hash rate was in Kazakhstan, where there are now power and internet outages. So this could be impacting crypto in the short term as well. We'll end it with a joke. Savon Henrik says, breaking ARC to change the ticker to Titanic. Okay, guys. So I kept you on for about 2 hours. And yeah, so next week we got some inflation data. Very good. Any questions before? How is Rosecoin? Is it a good investment since we missed Solana? I'm not familiar with Rosecoin. All right, gentlemen. So we will be back on Monday. And if you're on a free trial, don't miss out on the next trade alert. Call Dean at 505-322-7515 to upgrade and gain access to the membership area. Here's our disclaimer. Trading's risky. You can lose your entire investment. Talk to your financial advisor. All right, guys, we'll see you back on Monday. We're hedged to the brim in case things break over the weekend. You have nothing to worry about. Bab says, what should a first-time investor get into? Yeah, well, I would follow the trading plan. Absolutely, yeah. I like the 70-30 combo. If you want to be more risky, go into the high-risk strategy. If you want to be safer, go into the safe growth strategy. But yeah, I'd never make a recommendation to not follow the trading plan. So. Very good. Great audience today. Thank you guys so much for joining us live. Hope you enjoyed the content, and we'll see you back on Monday. Have a great weekend. Thanks.